Well, I would think the ability of local banks to compete with long-standing international banks which have had a presence in Turkey for a long time is one of the factors. I would also add the fact that there are more international banks coming into the local market as well. So there's an increased interest in Turkey from banks from the Gulf area, as well as Asian banks as well are coming into Turkey as well. And there has been an increase in the volumes being assigned to Turkey as a result of the disappearance, let's say, of Russia and Ukraine as regional competing markets for a scarce number of funds coming from international banks. You add to that the fact that local banks are able to do longer tenors and large amounts, and the result is increased competition, which is driving pricing down. In line with my previous response, you will see that there are a significant number of foreign banks coming into projects in syndicated deals in Turkey. Now, you have to keep in mind that the syndicated loan market in Turkey is dominated by short-term FI deals, and this comprises about 2/3 of the overall volume. And these are really short tenors, and a lot of the banks that come in do so for relationship purposes. Now, if you put that FI sector on the side and focus on the remaining third, then those are longer tenor corporate and infrastructure syndicated loans, which the proportion of which is increasing as a proportion of the overall market, and the amounts of which is also increasing together with the tenors. So this is pushing tenors out, and what it is doing, it's ensuring also that, again, increased competition means prices do go down. Now, it depends on how you define the region. The region for Turkey, around Turkey, is very conflicted at the moment. You know, you have a market in Russia, which is basically non-existent at the moment. It's gone down from close to 53 billion to about 3 billion per year this year. Ukraine, apart from some deals in the agribusiness sector, is closed down for the wider syndicated loan market. Another regional market that you would say would be Greece, and Greece is also not really open for business, apart from a very small number of deals which are currently in the market. So you know, what you have here is you have Southeastern Europe, so that would be Bulgaria, Romania. Maybe the best comparable would be some of the other countries in Central Europe, and of those, I would say maybe Poland would be the best comparable, and it's a market that has also benefited from volumes being transferred from Russia into both Turkey and Poland. If you compare pricing in Poland, Turkey, and many of the borrowers in Western Europe, you will see, as has just been discussed in the syndicated loan panel discussion a few minutes ago, you will see that a lot of the pricing is really very comparable to those in Western Europe, and a lot of it is a little bit interesting from the point of view of the fact that the risk premium being assigned to Turkey is almost lower than the one being assigned to Western Europe on an all-in basis. So obviously the pricing is much higher the risk premium is higher in Turkey, but the overall all-in pricing is the same. So something is a little bit off, perhaps. This is a key event in the syndicated loan market in Turkey. I think it's widely acknowledged that since the inception of this conference back in 2011, this has quickly become a key event where people come to exchange ideas, assess trends, and basically interact in a very complete 2-day event covering not only the issuance side, also the corporate side and new product development, which is very necessary in Turkey.